Equities as an asset class have delivered superior returns compared to other asset classes in general, but they have come with higher volatility. That's where a balanced advantage fund comes in. Before diving into how a balanced advantage fund works, let's understand why it's needed. A balanced advantage fund is an open-ended dynamic asset allocation fund that dynamically adjusts equity exposure based on a predefined framework that responds to market fluctuations. How? Let's play a small quiz. Let's say you know that the market will double in, say, the next 2 months, and you have the option of investing in a fund that gives you 100% equity exposure and another fund that gives you 65% equity exposure with monthly rebalancing. Which one would you choose? The right answer is, it depends. How? Let's understand this quickly with an example. Let's say you invest ₹100 today. If the market skyrockets by 900% in the first month, your NAV will increase to ₹1,000. But if the market crashes by 80% in the second month, your NAV would drop to ₹200. Now, let's see what happens with a balanced advantage fund. With 65% of your portfolio exposed to the market, a 900% rise would bring your NAV to ₹685. However, when the market drops by 80%, your NAV would only decrease by 52%, leaving you with ₹328.8. Hence, in investing, the path of returns, especially in volatile markets, matters and determines the overall experience. In volatile or negative markets, money saved is money earned. At Helios, our Balanced Advantage Fund aims to capitalize on equity upside while mitigating downside risk. To achieve this, we use two models: Exposure Management Framework and Elimination Investing Philosophy. The Exposure Management Framework is based on 4 key pillars that determine equity exposure. Macro conditions includes economic indicators like GDP, inflation, tax rates, political stability, and central policies. Valuations monitors the valuation of major Indian indices versus historical data. Market conditions tracks investor sentiment, cash activity, IPO demand, and more. Market sentiment analyzes momentum indicators, the India VIX index, and other factors. Equity exposure is reduced when all pillars are red and increased when all are green. Our second model, the Elimination Investing Philosophy, focuses on deciding what not to invest in. We believe that one of the most crucial steps in investing is determining what to avoid. Our Elimination Investing Philosophy uses the following 8 critical factors to reject companies. If a company is rated bad on any of the top 6 factors, it's eliminated from our consideration. If a company is rated bad on the 7th or the 8th factor, it goes on a willing to buy but not now list. Only companies rated not bad across all 8 factors make it to our core buy list. These models help us construct a strong, all-weather portfolio. Helios Balanced Advantage Fund aims to provide you with long-term growth, stability, tax efficiency, and liquidity. The fund doesn't take any duration risk, as the endeavor is to participate in the equity markets strategically and generate returns from equity and equity arbitrage. For example, if the fund endeavors to go for a net equity exposure of 65%, the balance is invested in arbitrage and money market instruments. Invest in the Helios Balanced Advantage Fund today to gain an edge in managing market volatility. Start your investment journey now. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.